What if I told you that your next big real estate investment opportunity could be in a country you've never visited? That's right. While local real estate markets might seem competitive, the global property market offers untapped potential. From the sunny shores of the Mediterranean to the bustling streets of Southeast Asia, there are countless investment opportunities around the world waiting to be discovered. The idea of international real estate investing isn't just for the wealthy or well-traveled. In fact, more and more everyday investors are branching out beyond their borders, capitalizing on high-growth markets and lucrative rental yields in foreign countries. 1. In this episode of Muscular Brain, Fat Wallet, we're going global. 1. We'll explore the benefits of investing in international real estate, examine the risks, and provide practical steps for getting started. 1. Whether you're looking to buy a vacation home, expand your rental property portfolio, or invest in emerging markets, this video will give you the insights you need to make informed decisions. Section 1. Why invest in international real estate? Global wealth distribution. 1. One of the most compelling reasons to invest in international real estate is the global wealth redistribution taking place. 1. As economies around the world grow, new middle and upper classes are emerging, particularly in countries like China, India, Brazil, and Vietnam. 1. These rising economies often have rapidly appreciating property markets, providing investors with opportunities for significant returns. 1. For example, cities like Ho Chi Minh in Vietnam have seen double-digit growth in real estate values over the past decade. Currency diversification. 1. Another key reason to look at international real estate is currency diversification. 1. By holding assets in foreign currencies, investors can protect themselves against inflation or devaluation in their home currency. 1. For instance, if the US dollar weakens, holding property in stronger currencies like the euro or Singaporean dollar can offset potential losses. 2. Additionally, certain countries have much lower costs of living, meaning investors can purchase property at lower prices while still earning solid returns on rental income. 2. Locations like Mexico, Colombia, and Thailand offer significant value for investors looking to stretch their dollars further. Investment in emerging markets. 1. Many emerging markets are experiencing a boom in real estate development. 1. Rapid urbanization, population growth, and increased foreign investment are driving up property values in cities across Asia, Latin America, and Africa. 1. Countries like Indonesia, Kenya, and Peru are seeing strong GDP growth, which often translates into increased demand for housing and commercial properties. 2. These markets offer a unique opportunity: the potential for high appreciation and rental yields in cities that are still developing. 2. While the risks may be higher than in more established markets, the rewards can be substantial. Second home versus investment property. 1. When venturing into international real estate, investors should also consider the purpose of their investment. 1. Are you buying a second home for personal use, or is this strictly an investment property? 1. A second home in a foreign country can serve as a vacation spot, a potential retirement home, or even a part-time rental property. 1. On the other hand, an investment property is typically purchased with the intent of generating rental income or flipping it for profit. 1. Each approach comes with different tax implications, management requirements, and financial expectations. Section 2. Benefits of international real estate investment. High-growth markets. 1. Investing in international real estate allows you to tap into markets experiencing rapid growth. 1. For example, the UAE has seen a surge in real estate development over the past 2 decades, particularly in cities like Dubai and Abu Dhabi. 1. The country's tax-free income, along with its strategic location as a global business hub, makes it an attractive destination for foreign investors. 2. Other markets, such as Malaysia, Portugal, and Greece, offer opportunities for growth through various incentive programs for foreign buyers. 2. These countries are known for offering residency permits or even citizenship to investors who purchase real estate above a certain value threshold. Potential for rental income. 1. Many international markets offer high rental yields, especially in tourist-heavy locations. 1. For example, properties in Bali, Indonesia, or Tulum, Mexico, can generate significant rental income due to high demand from tourists. 1. Short-term rentals through platforms like Airbnb have made it easier for property owners to tap into this revenue stream, especially in areas where tourism is booming. 2. In addition, long-term rental opportunities abound in cities with growing expat communities or rapidly urbanizing populations. 2. Investors can buy properties in developing cities at lower prices and rent them out to locals or expatriates seeking affordable, high-quality housing. Tax benefits. 1. Some countries offer favorable tax policies to foreign investors. 1. For example, Panama has no capital gains tax on certain real estate transactions, and other countries, like Portugal and Italy, offer attractive tax incentives through their Golden Visa programs. 1. These programs often allow investors to qualify for residency or citizenship after investing in real estate, providing an added benefit beyond financial returns. 2. Additionally, many countries have lower property taxes than the US or other developed nations, meaning ongoing costs of ownership are reduced. Asset protection. 1. International real estate can also be used for asset protection and estate planning. 1. In some cases, owning foreign property can provide a safe haven for assets, particularly in politically unstable or economically volatile home countries. 1. For example, investors from countries with strict capital controls or high tax rates might use international real estate to diversify their holdings and protect their wealth from government intervention. Geopolitical benefits. 1. Investing abroad also offers geopolitical diversification. 1. By owning assets in multiple countries, you reduce your exposure to political or economic instability in any one region. 1. For example, if a country experiences hyperinflation, currency devaluation, or significant political unrest, investors who hold real estate in more stable countries can avoid being overly impacted by those events. Section 3. Risks to consider: legal and regulatory challenges. 1. Navigating foreign legal systems can be one of the most significant challenges when investing in international real estate. 1. Property laws, ownership restrictions, and transaction processes vary widely from country to country. 1. Some countries, for instance, prohibit foreigners from owning certain types of land, while others impose additional taxes on foreign buyers. 1. It's crucial to understand the legal landscape and work with local professionals, such as lawyers and real estate agents, to ensure compliance with local regulations. Currency risk. 1. One of the inherent risks in international investing is currency fluctuations. 1. Exchange rates can change rapidly, and a strong home currency might mean your foreign investment is worth less when converted back. 1. Conversely, a weaker home currency could make foreign investments more expensive to acquire but provide greater returns in the long run if the local currency appreciates. 1. Investors should consider currency hedging strategies or invest in markets with relatively stable currencies to mitigate this risk. Market volatility. 1. Real estate markets in developing countries can be volatile, with property values subject to rapid changes due to shifts in government policy, economic conditions, or foreign investment trends. 1. For example, a sudden change in government leadership could lead to property market instability in certain regions. 1. As an international investor, it's critical to stay informed about both macroeconomic trends and local political developments that could impact your investments. Property management. 1. Managing a property from abroad presents its own set of challenges. 1. Unless you plan to live in the country where your property is located, you'll need to hire a local property management company to oversee the day-to-day maintenance, tenant relations, and rent collection. 1. Finding a trustworthy, reliable management firm is essential for ensuring your investment remains profitable. 2. Property management fees can vary greatly depending on the country and the services provided, so it's important to factor these costs into your investment analysis. Political and economic instability. 1. Political or economic instability can significantly impact property values and rental demand in certain countries. 1. For example, economic downturns, civil unrest, or sudden changes in government policy could lead to decreased demand for real estate or even make it difficult to sell or rent out properties. 2. It's essential to carefully research the stability of the country you're investing in and consider diversifying across multiple markets to mitigate this risk. Section 4. Investment strategies. Buy and hold strategy. 1. The buy and hold strategy is one of the most popular and straightforward approaches to international real estate investing. 1. This method involves purchasing a property in a high-growth or emerging market and holding onto it for several years to benefit from property value appreciation. 2. For instance, cities like Bangkok, Thailand, or Medellin, Colombia, have seen consistent growth in property values over the past decade. 2. Investors who purchased properties in these cities years ago are now seeing substantial returns as both property values and rental demand have increased. 3. This strategy works well in markets with steady economic growth, increasing tourism, and growing expat communities. 3. However, it requires patience and a long-term outlook, as property appreciation can take time, particularly in developing markets. Flipping properties. 1. Another strategy is flipping, where an investor purchases a property at a below-market price, renovates it, and sells it for a profit. 1. This approach can yield significant returns in markets where real estate prices are rising quickly. 2. However, flipping internationally comes with additional challenges. 2. Investors need to have a solid understanding of local renovation costs, permits, and construction standards. 2. Partnering with a local contractor or real estate agent can help you navigate the nuances of the market. 3. An example of a market suitable for flipping is Mexico's coastal areas, where beachfront properties can be purchased at a discount, renovated, and sold at a premium to vacation homebuyers or retirees. Vacation rentals. 1. Short-term vacation rentals have become increasingly popular with platforms like Airbnb and Vrbo, particularly in tourist-heavy destinations. 1. Owning a property in places like Bali, Indonesia, or Santorini, Greece, can provide lucrative rental income during the high season. 2. Vacation rentals can generate significant cash flow, but they also come with additional management challenges. 2. Cleaning, maintenance, guest communications, and booking management can be time-consuming. 2. Many international investors hire local property managers to handle these tasks. 3. Before investing in vacation rental properties, it's crucial to understand local regulations. 3. Some cities or countries have restrictions on short-term rentals, and failing to comply can result in fines or legal issues. Commercial real estate. 1. Investing in commercial real estate abroad can be a highly profitable venture, especially in countries experiencing rapid economic development. 1. Commercial properties such as office buildings, retail spaces, and warehouses in cities like Dubai, Singapore, and Mexico City are in high demand due to the influx of multinational corporations and expanding local businesses. 2. Commercial real estate typically requires a larger upfront investment than residential properties but can offer higher returns and longer-term leases. 2. It's also less volatile in certain markets, as businesses tend to sign multi-year leases, ensuring a steady income stream. 3. Investors should research local business trends, economic forecasts, and commercial property regulations before diving into this market. REITs and real estate crowdfunding. 1. For investors who are not yet ready to manage physical properties abroad, investing in international real estate investment trusts, REITs, or real estate crowdfunding platforms is an excellent alternative. 1. REITs allow investors to pool their money into a professionally managed portfolio of international properties, providing exposure to global real estate markets without the need for direct ownership. 2. REITs can be publicly traded or private and often focus on specific regions or types of properties, e.g., commercial, residential, or hospitality. 2. Similarly, crowdfunding platforms enable investors to participate in real estate projects abroad with lower initial investments. 3. This option is ideal for investors who want global diversification without the complexities of direct property management. Section 5. Practical steps to get started. Research the market. 1. The first step in international real estate investing is thorough market research. 1. Investors need to assess the economic conditions, political stability, and real estate trends of the country they're considering. 2. Tools like World Bank data, reports from global real estate firms, and platforms like Numbeo, which tracks cost of living data, can help investors get a clearer picture of a country's growth potential. 2. Key metrics to look for include GDP growth, population growth, and foreign direct investment. 3. Local demand is also essential. 3. High population growth or strong expat communities often signal good rental opportunities. 3. For example, countries like Malaysia and Portugal have thriving expat communities that drive demand for rental properties. Understand local laws. 1. Every country has its own set of rules and regulations governing foreign real estate investments. 1. Some countries impose strict ownership restrictions on foreigners, while others offer incentives such as residency permits for investors. 2. For example, Thailand allows foreigners to own condos but not land. 2. In contrast, countries like Spain and Portugal offer golden visa programs that grant residency to investors who purchase properties above a certain threshold. 3. It's important to work with a local real estate lawyer who can guide you through the legal process, including title verification, tax compliance, and any restrictions that apply to foreign ownership. Financing your purchase. 1. Financing options for international real estate can vary depending on the country. 1. Some investors may choose to pay cash, particularly in markets with lower property prices like parts of Southeast Asia or Latin America. 1. Cash purchases can streamline the buying process and avoid complications with foreign mortgage lenders. 2. However, in some countries, it's possible to secure financing through local banks, though this can be challenging for non-residents. 2. In markets like Europe or the UAE, foreign investors can access mortgage products, often requiring a larger down payment than in their home countries. 3. Another option is to refinance an existing property in your home country to free up cash for an international purchase. Managing from abroad. 1. One of the biggest challenges for international property owners is managing the property from afar. 1. Hiring a local property management company can make this process more manageable. 1. These companies can handle tenant relations, maintenance, and rent collection, allowing you to focus on the investment side of things. 2. Digital tools like property management software, virtual tours, and communication platforms also make it easier for investors to keep track of their properties remotely. 3. Investors should also consider the cost of property management services, which typically range between 8% to 12% of rental income. Build a local team. 1. Having a reliable local team is critical to the success of your international real estate investment. 1. This team should include a real estate agent, lawyer, property manager, and potentially a tax advisor. 2. Your real estate agent will be your eyes and ears on the ground, helping you identify suitable properties and navigate the local market. 2. Your lawyer will handle the legal aspects of the transaction, ensuring that the property is free of any encumbrances and that the deal complies with local regulations. 3. A local tax advisor can help you understand your tax obligations, both in the country where the property is located and in your home country. 3. Double taxation agreements, DTAs, between countries can help avoid being taxed twice on the same income, but it's important to get professional advice on this matter. Section 6. Case Studies. Case Study 1. Mexico's Riviera Maya. 1. The Riviera Maya, located along Mexico's Caribbean coast, has become a hotspot for international real estate investors, particularly in cities like Playa del Carmen and Tulum. 1. In this case study, we follow the journey of an investor who purchased a beachfront condo in Playa del Carmen with the intent of using it as a vacation rental. 2. After conducting market research, the investor found that the area's growing tourism industry and increasing number of expatriates made it an ideal location for a short-term rental property. 2. The condo was listed on Airbnb and Vrbo, generating steady rental income during peak travel seasons. 3. The investor worked with a local property manager to handle guest check-ins, cleaning, and maintenance, allowing them to manage the property remotely. 3. The property's value appreciated significantly over 5 years, thanks to increased demand in the region. Case Study 2. Portugal's Golden Visa Program. 1. Portugal's Golden Visa Program has attracted thousands of foreign investors seeking residency in the EU. 1. In this case, we explore how an investor purchased a residential property in Lisbon to qualify for the program. 2. The investor researched Portugal's real estate market and found that Lisbon's booming tourism industry and growing tech sector made it an attractive location. 2. By purchasing a property worth €500,000, the investor not only qualified for the Golden Visa but also generated rental income by leasing the property to expatriates and digital nomads. 3. Over time, the investor benefited from Portugal's favorable tax policies and saw the property's value increase as Lisbon continued to grow as a prime destination for both tourists and professionals. Case Study 3. Dubai's real estate boom.